It's also our first event for 2026, and I was talking to someone in the foyer. It couldn't be better timing given what's happening both domestically and globally. If you think about, in particular, the last week or two, but lots happening economically, both here and abroad. If you think politically, technological advances, think around AI, and of course over the weekend just gone, the conflict in the Middle East. So there's plenty for us to talk about. All of those things impact markets and investment decisions in different ways, and we're delighted to also welcome this afternoon our partners from BlackRock. So Navin and Beatrice, thanks so much for joining us. We've got some great presentations lined up through the course of the evening. And last but not least, it's fantastic to look out over the room and see so many of our wonderful customers, our loyal customers. So thanks so much again for taking the time to come out. It's a high trust relationship that we have with you all. It's not lost on us. It's an obligation we take quite seriously. And the team behind the scenes are working really hard to make that experience, that investing experience, an even better one. So we thank you for your support. We thank you for trusting us to partner with us, and we're happy to play a role in your investing and your wealth creation experience. So thank you so much for your support. We appreciate it. I'm going to just quickly, I've got our legal and compliance team here somewhere, so I'm going to show it, Gavin, I promise you. No. Technological glitches. Oh, I've gone too far now. I'll talk to this very quickly, Sam. A reminder, this afternoon is general information only. None of your personal financial circumstances or conditions have been taken into account, so please don't take this as personal financial advice. As always, do your own research. If appropriate, seek proper financial advice. So a quick touch on the agenda, and I'll leave that on the screen short for a little while because in the bottom right is a sort of a really large QR code. We'll be having a section later on around some Q&A, so if you'd like to sort of pose a question to the panel, please scan that QR code, input your question, and we'll hopefully get to that as part of the Q&A or the panel discussion. We've got some questions already loaded up. We'll do our best to get to as many of those questions as we can. But yeah, please scan the QR code, drop your questions in the app, and we'll try and get to as many of those as we possibly can. But in terms of the agenda, we've got, as I said, some great speakers here from BlackRock, two high-quality presentations from Navin and from Beatrice, and then we'll have that panel discussion with Ritesh, who's the Chief Investment Officer at Syfe. We'll do a quick close, and then we'll get you back out to the foyer for some sort of post-event canapes and drinks, where we'd love to keep the conversation going. You might have seen the staff in the blue or the white Selfwealth plus Syfe t-shirts, hard to miss. So we'd love to chat to as many of you as we can. Please stop and have a conversation. Ask as many questions. We're open to feedback. We launched our new mobile app, which Sam will talk to shortly, a few weeks back, which is fantastic. But yeah, we'd love to see as many of you as we can after the event for a follow-up conversation. In terms of the speakers, that's the lineup for this evening. Samantha Horton, Chief Operating Officer from Syfe, he's out from Singapore, as is Ritesh Ganariwal, he's the Chief Managing Director, Head of Investment Advisory at Syfe, also out from Singapore. Navin Saigal, thank you for joining us, Navin, Head of Global Fixed Income, Asia Pacific at BlackRock, and Beatrice, the multi-asset strategist, also from BlackRock. So, as I said, some high-quality presentations to hopefully unpack some of what's happening in the world at the moment and here, and to not give you personal advice, but help make some sense of it all. On that note, I'm going to invite Sam up the stage for some opening remarks. So, thanks, Sam.
Thanks, Brendan. And I'll echo what Brendan said, and thanks so much for everybody for making time today to join us this evening. So I won't take too long because I know you're not here to listen to me talk about Syfe, etc. But we're more interested to hear it from BlackRock and from Ritesh, on the market outlook. But but really excited that this is our first ever and inaugural 2026 Market Outlook event. We do a lot of these events with partners such as BlackRock across the group in Singapore and in Hong Kong, and we're really looking to do a lot more of those to Australia in the coming months and years ahead, right? And hopefully that's what we do bring as part of the broader Syfe group to the self-wealth community. So I know for many of you, you may not know, a lot about self-wealth. You may not know as much about Syfe. So just wanted to do a quick introduction to also give you an idea about what's to come going forward, right? So we are Asia Pacific's largest digital wealth platform. We have over $10 billion of US dollars of assets and over 400,000 customers across Asia Pacific. And that is across Singapore, where we started, Hong Kong, and then obviously now in Australia. So Syfe is really about empowering people to build long-term wealth. And that's why the partnership with Selfwealth was a really symbiotic one, because that's exactly what Selfwealth's mission has always been through the years as well. And we're really looking to double down and build on that with this partnership with Selfwealth. So we are, as I said, fully licensed across Singapore, Hong Kong, and Australia, and we focus not just on DIY brokerage, but on holistic long-term wealth management, which I'll touch a little bit upon shortly. But really built across the three pillars that we'd like to talk about, our 3 A's of access to the highest quality investments with the right advice and at the right affordability to really bring that to the broader retail customer base. So just a couple points on this. So we started 7 years ago in Singapore in 2019. Had a number of milestones since then. We started to manage portfolios. So again, on the investment side with portfolios that were built both in-house and with partners, again, such as BlackRock. And subsequent to that, we've launched into cash and income products. We've also launched a brokerage in Singapore in 2022. And obviously, a big milestone for us was the Selfwealth acquisition last year in May to really bring this to Australia. So as the product you would know right now for Selfwealth, so obviously brokerage across and access across Australia, Hong Kong, and US markets at a very transparent, flat fee price with easy to use platform, right? And what we're really excited about is now we're starting to see some of the work that a lot of the work that's gone on, behind the scenes over the last few months since the acquisition, to bring some of the new innovations that we bring as a group to Australia. And the first sign of that was the new app that we launched a few weeks ago. We took a lot of feedback into place. We've really rebuilt it to be future forward, to be much easier, streamlined investment process, right, in terms of buying your first stock, seeing your portfolio, et cetera. But what we're most excited about is that this is obviously the start of what's to come, in the next few months. And 2 new big in-demand features that we launched with it was auto investing, which I know was a big ask from our community to finally have that feature, and then more insights and discovery tools to help people make better investment decisions. So auto invest, I think many of you have probably seen it. If not, please check it out. Please check it out on our app. And essentially, this really goes to that pillars of being consistent with your investing, really investing for the long term. So being able to choose a stock or ETF, choose the amount that you want to invest in, choose the frequency that you want to invest in, and then set and forget, right? So starting to make strong investment decisions, not based on emotion, but based on consistency, which we all know. Time in the market is better than timing the market. So super excited about that, and again, just the beginning, of some of the things that we will look to bring in the next few months. The other is on the discovery tools. So again, we talk about access and advice. And this is that part around insights, right? So helping people to either get started, I don't know where to start. These are some easy ways for me to find the right stock or ETF to invest in across different sectors, different themes, analyst recommendations, which stocks are seeing the biggest earnings momentum, which stocks are getting the best, analyst recommendations, etc. This will top movers, right? You can see all of that through our discovery section now in the app as well. Top ETFs, so lots of BlackRock ones featured there as well. But what we're even more excited about is the future, right? And the future, as I said, really Syfe is about holistic wealth management. And what that means is moving not just from DIY brokerage, but into true long-term wealth building with cash and income solutions, so getting better yields that you can get if you leave your money at a bank, and then into ready-made portfolios that can help you grow your wealth for the long term, equity-based, equity, fixed income-based, etc., and really helping you to have the right tools, again, the right access, the right advice, at that affordable price point to build your long-term wealth, all on one, simple platform. And on that note, super excited to have Navin and BlackRock here today, and over to you.
Thank you, Sam. Thank you, Syfe and Selfwealth, and to all of you for coming and listening. It's my absolute pleasure to be here. I'm very honored. Let me start by saying that whether you're a tourist or a veteran Melburnian, chances are if you took a stroll down the Yarra River, you'd have passed the Crown Casino. And if you had chosen to go into the Crown Casino, chances are you'd have passed by a blackjack table at some point in that walk. And if you passed by that blackjack table, I'll tell you it is very difficult at first glance to tell who is gambling and who is counting cards. But that separation is absolutely critical. All right, I've titled my presentation, Gambling versus Investing. Now that separation is absolutely critical because the ability to go from gambling to counting cards gets you from a negative expected return at the table. Remember, the house has an advantage. You're expected to lose if you play blackjack. To a positive expected return if you count cards perfectly. And that is why the casinos hate card counters. Even though in the US, at least, it's not technically illegal. I know in Macau it is. It's frowned upon in all casinos. It's so hard to tell who is doing the work and who has not based on a few hands of blackjack. And in the financial markets over the last few years, I think we've been in a very similar environment. It has been very hard to differentiate the gamblers from the investors. Over the last 3 years, the returns you've got in bonds and in stocks are simply incredible. The average bond market has delivered mid-single digit to high single-digit return every year for the last 3 years. And the average stock fund, mutual fund in equities, has delivered probably a double-digit return every year for the past 3 years. It's been a little harder to beat the indices, but most people are content with a single-digit return in stock and fixed income and a double-digit return in stocks. We think that's about to change and has already started changing, and going forward, it will be extremely important to have done the work. Going back to the blackjack example, a lot of work goes into card counting. You have to sit there counting hand after hand, memorizing, just to get that handful of percentage points extra in expected return, but it's worth it, right? All those percentage points are worth it for all that work. It's exactly the same we feel in investing in today's markets. Just this year alone, if you look at the top left chart, equity dispersion, meaning how volatile individual stocks have been inside the index relative to each other, is at highs that we have not seen since the global financial crisis of 2008. This is even higher than in COVID. So if you showed me this chart in isolation, the top left, I would have thought stock markets must have tanked, but they actually haven't. They've been actually pretty resilient. So something else is clearly going on here. And you can see a bit of that in the top right and the bottom charts. In the top right, I'd have never expected a private credit or private equity company like Blue Owl or Blackstone or KKR to be more correlated to software than semiconductors are to software. But that's exactly what has happened. The correlations that we used to rely upon have not been reliable. And things like semiconductors and software have moved in diametrically opposite directions. You can see this in the charts on the bottom. Diametrically opposite directions, while the indices that both sectors reside in have stayed relatively flat. So being on the wrong side of these kinds of moves has been extremely punitive for investors. Why is this happening? I think the market is trying to grapple with tectonic shifts on two fronts, to keep it very simple. The first is an inflationary front, and largely in the rearview mirror. It looms large in the rearview mirror. It's partly driven, it's a lot driven, by pandemic-era policies that stayed on and continue to exist today. There's a 6% fiscal deficit in the US, as far as the eye can see, that's driving a lot of global growth. At the same time, if you look far enough ahead, I think investors are starting to see a very deflationary backdrop from the incoming AI agents that are quote-unquote supposed to take over all our jobs. Now, I don't think that's necessarily going to happen, but it is a looming fear. And that kind of labor substitution from having a technological tool, a tech revolution that can reduce the constraint of labor to output, that is something that the market is trying to grapple with, those two opposing forces. I think the charts on the left side of this slide encapsulate that tension perfectly. It is a brewing tension worthy of a Harry Potter story, and I see Catherine Palmer, my colleague, smiling because we're both huge Harry Potter fans. But it is a brewing tension between the inflation mandate or price stability mandate of central banks versus the employment mandate of central banks. We're still in a largely inflationary backdrop. People talk about inflation and prices have risen. Affordability is clearly a problem, whether it's in the US, Singapore, or Australia. But at the same time, jobs are not being created along with economic growth at the pace that they used to be. If you look at the top left chart on this page, in the last 2 quarters of 2025, US real GDP, so US growth, was at 4%. That's an unusually high number for the US economy, 4% for a half-year period. In every other instance where the US has grown at a 4% rate, jobs have grown along with it. Last year, the second half was the first time, the most recent 2 quarters is the first time that jobs have been lost, ex healthcare, at the same time that growth has been at 4%. Why do we take out healthcare? The only reason is because healthcare tends to be more of a stable, kind of less cyclical industry, which is benefiting quite a lot from an aging demographic. So it's operating on a different cycle, and that cycle's helping. Another way to put this, so that line would be positive if you included healthcare. Another way to say this would be that healthcare is doing a lot of heavy lifting in holding up American job growth. I think that's true for a lot of the rest of the world, but the data in the US is some of the best, which is why we tend to use US data in these presentations. Nonetheless, the central banks are having to face this tension, and I think this is where fixed income can come in, where portfolios can be built to be more resilient, to take advantage of this tension and some of the ensuing possibilities. Okay, one more. On this slide, some of that growth that I outlined in the previous slide, right? Why is the US economy growing so fast but not hiring so many people? Well, a lot of that is due to tech investment. I'm sure everyone here has read about some of the deals that are being done in the tech industry, either bond deals, equity deals. There's a lot of activity going on. Money is being raised. Data centers are being built. Australia is not immune to that either. That's a global phenomenon. And now I think people have started to wonder whether there is an overbuild and too much money is being spent, such that if growth was being held up by all this tech investment, what happens if that slows down or is a bubble, quote unquote? I think all those concerns are valid, but they do have to be taken into consideration with what is the cash flow on the other side. And I think that's where the market has largely failed to appreciate the size of the potential transformation. Again, if you can substitute labor, which has historically been the biggest constraint to humanity's output, then I think we're talking about a different kind of paradigm. So we at BlackRock, we tried to do the math. My team worked on this math. I'll actually simplify it more than what's on the page because I'm not a very mathy person. But if you start with, say, business output, and again, we use US data because it's kept very clean. If you start with business output of, say, 24 trillion in the US, and the labor and the wages and salaries compensation to labor portion of that is about 10 trillion, to use a round number. It's probably actually 12, but it's 10 trillion a year as a round number. Then you can start doing some interesting math around that. If you think that maybe 10% of labor can be substituted, of the labor cost can be substituted by AI agents, that's a 1 trillion number annually. Now you've got a number from which you can start to build a multiple on. The S&P 500 trades at a 20 times multiple. If you apply that same multiple to that 1 trillion number, now you're talking about a 20 trillion block of cash in the future that I think people are trying to evaluate that number. And you can construct a sensitivity analysis. You can say maybe it's 10% of labor that's being substituted or 20%. How does that change the math? It makes it grow bigger, that final amount. So the present value of that future cash flow is very uncertain. And I think that's what's driven a lot of the dispersion in the market as people try to evaluate what exactly that cash flow is and how much labor gets substituted. But you can see that with those gargantuan numbers, 20 trillion, whatever it may be, 40 trillion, that's how all the investment makes sense. Now, it's causing a lot of dispersion in many markets. I think this is a ripe opportunity for fixed income investors to take advantage of that. Every country is basically having its own inflation and growth dynamic. It's moving along this transformation at its own pace. That's giving central banks the ability to cater monetary policy, and bond yields are basically moving in ways that we've not experienced. This chart on the left just shows how divergent bond yields in parts of the Asia-Pacific region have been to the US. In the US, they're expecting 60 basis points of cuts by the Fed. Australia obviously has been running at a much hotter pace, and you're expecting 40 basis points of hikes, roughly. That's a 100 basis point differential, a 1% differential between the US and Australia. That's a huge number for us fixed income investors. That doesn't usually happen. But I think it speaks to the opportunity available in the fixed income market to build a portfolio that's diversified across countries and that gets you an income stream that can bring you resilience in your portfolio. On the right side, I just put a chart on how the tech build-out is likely to occur. In the past, it's been financed mostly by equity, free cash flow, and the cash on hand of these tech companies. But going forward, we're expecting it to be much more reliant on debt financing. And that gives us both a risk and an opportunity. The risk is that too much debt may be issued at poor underwriting standards, but the opportunity is that at the same time, there will be good deals to be had. And I'll give one example, was this famous, got in the papers, deal by Facebook or Meta last year. They built a data center in Louisiana, and they financed it entirely with debt off their balance sheet. Now, it sounds risky, but actually, Meta's cash flows were pretty confident, so BlackRock took a big stake in that deal. And I think those are the kinds of opportunities that will help us to build resilience in a fixed income portfolio. So there's a lot of numbers on this slide, and if you didn't bring your magnifying glass, you're probably not going to be able to see them, but I'll just give you some highlights. So we're calling this the golden age of fixed income, because given some of the shifts that are occurring, the fact that you've got inflation still high, growth still high globally, and this disinflationary backdrop in the future, that uncertainty, coupled with the fact that interest rates and yields are still at relatively high levels, is giving us an opportunity to lock in a 5, 6, maybe even more than 6% yielding portfolio. That's a 6% income stream in relatively safe fashion. There's not a lot of volatility in this income stream, not a lot of drawdown risk. If you're familiar with the concept of duration, we use short duration bonds largely inside of 5 years to construct this kind of income stream. And I think this is the opportunity that is being underappreciated by a market that is saturated with uncertainty and bad news in the papers. When there's already so much uncertainty in the media, in the world out there, What you want from your fixed income portfolio is for it to be more boring, more certain. And we think the market's actually giving us the opportunity to do that today. You can build a 6% yielding portfolio in 5.5%. That's still pretty good, especially relative to inflation, using the global suite of tools available to a fixed income investor. And I stress that part. I think being able to go global and use the entire suite of tools is very important, whether it's investment grade, some high yield bonds, short duration, or even floating rate notes, which have very little duration. Those are all tools that we think are essential, and that's that list of assets down the side that are too small to see going into this portfolio. So let me stop there and just recommend one last thing, which is, it's the golden age of fixed income, probably the golden age of investing. Whether you're looking at the US, Europe, or Asia, there is something to do, whether it's fixed income or equities. So use the capital markets and the compounding that is available today in fixed income to work for you and build more resilience in your portfolio would be my advice, and we are here to help.
Thanks, Navin, for a really insightful presentation. And as I said earlier, Navin will be here later on as well for sort of further follow-up and questions and to help make a bit more sense of some of those numbers on a few slides. So thanks so much, Navin. We appreciate the presentation. I'd now like to call up to the lectern Beatrice for her presentation.
Very good evening to everyone. It's wonderful to be here tonight, and thank you again to Syfe and Selfwealth for inviting BlackRock to be a part of this event. Now, as my colleague Navin pointed out, it certainly is a very interesting and, in fact, very fascinating time to be in markets at the moment, with lots happening, lots of market movements, lots of market shifts happening, even as we speak. And, the market movements of the last couple of weeks very much reminds me of a famous quote by a pretty well-known politician that pretty much says, there are decades where nothing happens, and there are weeks where decades happens. The second part of this quote certainly encapsulates and very much reflects, the recent market movements that we've seen, not just over the last week, but even over the weekend, right, with so much going on, where we're seeing, sharp market rotations, ongoing market, shifts in market leadership, and importantly, elevated dispersion, both across and within asset classes. Now, whenever I mention the word dispersion, whether it's to my family or friends, I find that, people tend to feel very uncomfortable, right, with the word dispersion, as it often implies, greater uncertainty of outcomes. But if we really think about it, uncertainty is actually not such a bad thing after all, right? What is the definition of uncertainty? Uncertainty doesn't mean certainty of a bad outcome. It simply means certainty of a wider range of outcomes. And while the wider range of outcomes may make us feel uncomfortable, as investors, we think it actually creates opportunities for us, as it effectively widens the opportunity set and increases the breadth of our opportunities to identify winners, to avoid losers, and importantly, to enhance portfolio outcomes. Just think of investing like, the game of tennis. Any tennis fans here or players of tennis? Yeah, a few of you. Now, imagine you're playing a game of tennis and you're just playing, one set. So not even one match, but one set in a match. The chances of you winning are probably a bit lower, given that the amount of shots that you can actually play back to the competitor is quite low. But I think tennis is such a unique sport because it offers us as players so much more opportunities to score. Because if we look at the way tennis goes, right, there's multiple sets in one match. There are multiple points in one set, and importantly, there are also multiple ways to actually hit one shot. And so having that breadth of opportunity really increases our chance of scoring and our chance of success. And that's also why we've seen some of the key players, Grand Slam players, also dominate, just given that they have such a long history of track record to actually score. And I think the same is very much, the same principle very much applies in investing, whereby greater dispersion in markets very much gives us the opportunity, the breadth, to again identify winners and to double down on those winners and to avoid the losers. So what I want to do today is really to, highlight and really focus on the how. How do we go about identifying these opportunities? How do we go about navigating some of the currents in markets? And importantly, how do we position our portfolios to turn disruption into opportunity? But before we do that, I'll just set the scene in terms of where we are currently at with markets. So as we saw with Navin's slide, he showed us on the last 3 years, on an analyzed basis, you would have done really well, right, as an investor. But what if, we go further back? If we go all the way back to, 2 decades ago, looking at this chart, you see that one interesting, trend really emerges. The first is that you notice that ups and downs and volatility in markets actually more common than you actually think it is, right? If you go back, you see that the ups and downs and twists and turns, that's actually, normal. And, put it in context, the recent market volatility doesn't seem as scary as it seems. But I think the interesting trend to notice here is that, you notice that despite all the ups and downs and twists and turns in markets, an investor who stayed invested, who actually remained disciplined, stayed the course, actually came up the other side a lot, was ultimately rewarded. Say if you invested 100K at the start of, the peak of the GFC, for instance, you didn't choose to exit the market, you chose to stay invested. By today, you have actually received, 10 times, or in fact, over 10 times the initial investment you invested. And so I think this highlights a very key principle for us that, as Sam mentioned, time in the market is more important than timing the market. Now, looking ahead, we continue to believe that this principle of investing, this principle of staying invested, remains intact. It continues to hold going forward, even in this new market regime. However, what is changing is how we invest and where we invest in. I think that's going to be even more crucial in today's market regime than what we saw, over the last few decades. And if we think about the market regime that we're in right now, back during the Great Moderation era, which many economists refer to as the period post the GFC and before COVID, you could easily just blindfold yourself and just throw a dart anywhere and still garner a really solid return because it was an everything rally kind of market. And we saw common forces like low inflation, ample liquidity, and a lot of stimulus just pushing markets or asset classes in one direction, and that was upwards. But fast forward to today, I would say the market regime that we're in is a very different. It's marked by greater dispersion and also a greater range of outcomes. And we see that across both the micro and the macro level. On the micro level, as you see on the left there, if you compare stock dispersion, say 5-10 years ago, you would probably see that the average stock, 5-10 years ago, would probably have delivered about the same return as the index. But fast forward to today, things are very different. You see that the difference, the performance dispersion between the top performing stock and the worst performing stock has actually widened significantly. And to give you an interesting stat, just on a year-to-date basis, I'm sure many of you invest in the US equity market, but the S&P 500 on a year-to-date basis is pretty much flat or slightly negative. But did you know that the average stock within the S&P 500 has actually moved within a band that's more than 10 times what we have seen in the index level? And that's pretty phenomenal, right? That over a third of the S&P 500 have moved plus minus 20%, even as the index remained flat. And so simply just going into a static, market cap weighted portfolio and, set, forget, and just leave it as it is could potentially cause you to miss out on some of the opportunities that's happening underneath the hood. Similarly, on the macro front, we're also seeing a lot of dispersion even as we speak. A couple of years ago, it was very much U.S. exceptionalism, with U.S. equities significantly outperforming the rest of the world, including Australian equities. But fast forward to today, it's clearly does seem that the narrative is shifting, where we're seeing, ex-US markets, whether it's emerging market equities, whether it's Japanese equities, starting to outperform and catch up with the US. So lots of noise, and clearly that, the market narrative is shifting. So amidst the noise, how do we go about identifying opportunities? How do we find direction, amidst the disruption? Well, one place I often like to tell clients to look at is to focus on what we call the mega forces. Mega forces are what we call long-term, structural trends that will likely persist, regardless of what happens day in, day out. And here, we show you 5 key mega forces that, we here at BlackRock look at. There are things like digital disruption and artificial intelligence, which clearly is the talk of the town. But then there's also things like geopolitical fragmentation, which is very topical, right, given what we've seen in the Middle East over the weekend. demographic divergences with different demographic patterns leading to different economic output potentials in different regions, and also things like the energy transition and the future of finance. And I think it's important to note that when we talk about each megaforce, it's important not to think about it as one or the other. If anything, I would say markets over the last 2 years have very much been driven by the collision of these megaforces, whether it's the intersection of digital disruption and AI, as well as that of geopolitical tensions and the energy transition. But given some of the time constraints today, what I'd like to do is really focus on the first pillar, on AI. Navin touched on it a little bit, but I really just want to bring this to life and think about how do we actually turn those ideas into investment IP and implementation ideas within our portfolios. Now, when I speak about AI and digital disruption, I'm not just talking about the tech companies. I'm not just referring to your Mac 7 companies. The effects and the impacts of AI extends beyond, the tech sector into other areas of the economy. And this is important, especially as we move from different stages of the AI revolution. At BlackRock, we think that there are 3 key phases of the AI revolution, ranging from that of the initial AI build-out phase. So that's where, initially we have the infrastructure, the development of the tech to actually power AI. And then we move to the AI adoption phase, where it's becoming clear that beneficiaries are moving from just the tech creators to now the tech adopters. And then finally, the last stage is what we call the AI transformation phase, where once all sectors of the economy start to adopt AI in their day-to-day process, hopefully we get to see that boost and uplift in productivity growth that many economists are calling out. But I think worth calling out that, as we begin to move from one phase to another, there will be different opportunities. So right now, where are we at in this AI super cycle? I would say we're probably somewhere in the first 2 phases. At least that's where markets are currently pricing, where we're moving from what we call the AI build-out phase to the AI adoption phase. And during the AI build-out phase, clearly, the key winners here were things like the Mac 7 companies. Mac 7 accounted for over 40% of index returns in 2025 alone. And then other asset classes like infrastructure, clearly will also benefit from this AI build-out phase. But it's becoming clear that, especially this year in 2026, the narrative is starting to shift from that of optimism around the AI build-out to that of fears, about downside risks around the AI adoption. As markets are beginning to rapidly reassess and reevaluate business models to reward companies that can adapt, that can reshape cost structures as a result of the AI disruption, and punish those that are not able to adapt. And as a result of that, you clearly see on this slide that there is, that shift in markets leadership that we're seeing at the moment, that there's, the ongoing market rotation from that of US equities to ex-US equities, from that of large caps to that of small caps, and from that of growth companies to that of value companies. And we think that, in this market regime where we're going to see, increased disruption, increased dispersion, there's a need to be more selective when it comes to picking our securities, even within markets like US equities, where it's not just enough to say, I want to invest in the S&P 500. I think in today's market regime, it's going to be important to be selective. Within US equities, do you want more of a growth tilt? Do you want more of a value tilt? Or do you want more of a small cap bias versus a large cap bias at different points in time? So being selective, I think, is going to be even more important and crucial in today's environment. Now, beyond the US, I would say, what are some of the other opportunities that we see, benefiting from this whole AI digital disruption trade? Well, emerging market equities, in our multi-asset portfolios, we actually do like emerging market equities and have been overweight EM equities, since June last year, which in hindsight has worked pretty well if you looked at the returns on EM equities. And why do we like it? Well, I would say, one, clearly returns have benefited, but more importantly, as a diversified play. Emerging market equities, particularly EM Asia, places like Korea, like China, like Taiwan, we think that they offer really good opportunities for us to diversify around, across the tech supply chain, moving beyond, the US tech software developers to that of the hardware, suppliers or enablers. Whether you have, Korea being at the helm of, memory chip production, or that of Taiwan, being at the packaging and really leading the charge in terms of semiconductors. So we think that EM equities can also benefit, and it's also a good way to diversify whilst tapping into that AI trade as well. Beyond equities, infrastructure is also another asset class that we also do like having in our portfolios. With infrastructure, there's often a saying that since the beginning of human history, knowledge is power. And certainly that's true. But today I would argue that power is knowledge, right? You need energy, you need power to actually fuel the artificial intelligence. Just as how our human brains, require energy and carbohydrates to actually power, and to actually function. And so to give you, an idea of how much energy you actually need to, power AI, just think about ChatGPT-3, right? How many of you use ChatGPT-3 or ChatGPT here, actually? Yeah, pretty much everyone in this room. So I'm not even talking about the latest model of ChatGPT, but ChatGPT-3, which was launched back in 2022, the energy required to train that model could actually power over 90,000 homes for an entire year. Fast forward to 2023, when ChatGPT-4 came out, the amount of energy required to power that model could actually power over 2.5 million homes for an entire year. And so that just gives you, perspective in terms of how much energy and how much infrastructure we need to actually power that whole AI revolution. You need data centers, you need power grids, you need fiber networks, and we think that infrastructure, and real assets more broadly are likely to benefit from this whole build-out. Now, if we translate some of these asset class views that we just went into actual figures in terms of long-term expected returns and risk, what we show you here are our capital market assumptions. So looking at long-term risk and return expectations. And this is something that we at BlackRock, as a multi-asset team, we actually use them as inputs into constructing our portfolios across the board. Now, good news is that clearly the principles of investing holds here, where most asset classes are expected to deliver positive returns over the long term. In fact, much more than cash. And so again, staying invested and putting the cash to work is going to be important going forward. But I think what's even more evident on this slide is that where you put the cash to work and how you put it to work is going to be even more important, and it's important to be selective, right? Because whether you look at comparing the green dots, which is equities, to the yellow dots, which is fixed income, to the orange dots, which is private markets, clearly there's a lot of dispersion going on. It's not unified expectations. And even within the green dots, like equities, for instance, there's also a lot of dispersion going on if you compare that of US equities to that of European equities, Japan equities, China equities. And Australian equities, that's something I want to comment a little bit on. Aussie equities, clearly has had a pretty tough year, I would say, in 2025. But we're starting to see that, somewhat rebound over the last, year to date, over the last 2 months or so. Now, on a strategic basis, on Aussie equities, we think that, valuations are pretty expensive, and at the same time, earnings growth is also relatively weaker than what we're seeing offshore. However, I think it's worth mentioning that within Aussie equities, again, it's important to be selective at different points in time. Whether you look at Aussie large caps, which is, primarily financials and your banks, that might potentially benefit in different market environments compared to that of small caps, which has a lot of materials exposure, in particular gold miner exposure, which again might benefit at different points in time. So again, expressing your views via more granular building blocks, we think it's going to be important, going forward. So, finally, just to wrap up in terms of portfolio implementation, we've gone through a lot of ideas, a lot of IP in terms of how you can put some of those outlook and market dispersion into practice. But when it comes to implementing it in portfolios, I would say a couple of key guiding principles to think about. The first is that of diversification. As the saying goes, diversification is the only free lunch you get, maybe besides the one you just had or will have. But it really highlights the principle that it's important to diversify your assets, not just across asset classes, but even within asset classes like equities. How much do you want in developed market equities versus emerging market equities? And within developed market equities, how much home bias to Aussie equities do you want to have versus that of US versus Europe versus Japan? So it's important to be selective, especially in a market where we're seeing greater dispersion. And then finally, with vehicle implementation, also keep in mind that a more dispersed environment we think creates more opportunities for active management. But of course, I think the decision to use active and/or index really comes down to your investment philosophy, to your fee budget. But I think just something to keep in mind that I think in today's environment, it's no longer a question of active or index, but at BlackRock, we really like to think of a whole portfolio approach as having active and index for different purposes. So bringing all together, we've touched a lot on both across both Navin and myself, but just to summarize a few key takeaways, in short, we believe that we are in a new market regime that's characterized by greater dispersion. And while dispersion might make us feel uncomfortable, we think that investors can learn how to be comfortable with the uncomfortable by recognizing that dispersion, isn't a risk to avoid, but instead it's actually an opportunity to exploit. And so rather than exiting the market and sitting on cash in the sidelines, we think it's important to invest in the here and now and put the cash to work. Now, how you put the cash to work is going to be important as well. And we think that a key tip would be to use the mega forces that we just touched on to focus and importantly filter through different opportunities. And remember, to express your views in, a nimble, in a precise, as well as in a diversified manner. Because ultimately, in today's market environments where winners are scattered across the board, you win not so much by, depending on luck, but, the winner, just like in the game of tennis, very much depends on you diversifying your shots, acting with precision, and also adapting quickly to changing market conditions. So with that, I might hand it over back to Brendan. Thank you so much for your time today.
Okay, thanks so much, Beatrice. Again, good to have some of those key messages reinforced around time-in versus timing, and love the whole of portfolio chart and the analogy of a free lunch to diversification. Anyone who knows me well, I love a free lunch, so good to know, Beatrice, thank you. I'm going to introduce Ritesh to the stage as well, please, and Beatrice, if we can keep you up here on the stage and have a seat on the couch or the chair. Just going to leave that QR code up on the screen for 30 seconds or so as well. So got some great questions that have been coming through, so thank you for those. We'll try and group those questions into a few key themes. If you have any more questions, please keep them coming through. We'll do our best. There's quite a few questions that have come through, so we may not get to them. In fact, we won't get to all of those this evening, but I do promise we'll after the event in the next few days, an email will hit your inbox. We're actually recording this afternoon's session as well, so you'll have a recording or a copy of the whole presentation, the session, and we'll try to address some of those questions that we don't get to this evening through that follow-up. So on that note, let me just check the questions that have come through, and as I said, we'll try and group those into some key themes. So we'll start with a bit of a domestic flavour, and Ritesh, I might start with you if that's okay. But just around the inflation outlook, some commentary on the RBA and your thoughts on where that might land going forward.
Yeah, sure. Hi, everyone. Ritesh here. A pleasure to be here. Thank you. So on the inflation front, it has been sticky, driven by household and services components here in Australia. And if you look at the Feb meeting, there was a rate hike, and the present rate is 3.85%. As we move forward, the inflation components currently at 3.8%, I believe, in Australia. And with a tight kind of like labor market, we might see interest rates continue to move up in the near future. So there is a meeting upcoming in mid-March, and there is high likelihood that there might be another rate hike during that meeting. Looking forward for the rest of the year, we see that this high interest, high inflation environment continue to drive rate hikes in the near term. Looking at it in a more broader sense, the economy as a whole is kind of giving a little bit of mixed signals. I think Beatrice covered a little bit more on the stock side of it. On the growth side, and demand looks pretty strong. But at the same time, you are seeing, even the labor market, everything is resilient overall. So that looks strong, but on the other side, that also means that inflation can continue to creep higher, and things that are happening in the Middle East, etc., are also going to have ripple effects in this part of the world. So what that could mean is, on one side, the demand side is strong, but on the other side, because of the inflation backdrop, we might see on the household side living expenses move up, as well as overall the inflation backdrop requiring us to judiciously then think about how to participate in this below trend kind of growth environment. So overall, not looking at a recession in Australia, but looking at a below trend growth overall.
Thanks, Ritesh. And just staying on the theme of interest rates, maybe Beatrice, as a follow-up question, if rates do stay high for longer, what's BlackRock's view on that for both Australian equities, particularly sort of financials and resources, and also our currency?
Yeah, I'll probably touch on the first part first. So all things equal, if interest rates are higher, that's technically tighter financial conditions, and all things equal, that should potentially be a headwind for growth and risk appetite more broadly. However, to our earlier presentations, I think there is a lot of nuance underneath the hood, and so it's not to say the whole market will sell off, but I think important to be selective across different sectors at different point in time. And it's interesting you asked that question, Brandon, around financials versus materials, because we actually did a bit of research, on this topic just a couple of weeks ago, and what we found was that financials, intuitively, you would think that financials would actually do better, right? When rates are higher, when rates actually go up. Just given that, with the, issues around expanding margins and higher, net interest margins, you actually benefit some of the banks. But what we actually found was quite interesting was that, we found that actually financials actually outperform during rate cutting cycles. And that's because, rate cutting cycles often coincide with, economic stabilization, with improved lending conditions. And so, some of the banks actually benefit. In fact, we actually went back, all the way, back the last decade or so the last 10 years. And we found that 4 out of the last 5 cycles where financials actually outperformed the broader market was when, the RBA was actually cutting interest rates. So I think that's quite interesting, perspective to actually have. That's not to say that we think that financials will underperform, in this, rate hiking cycle. I think it really depends on, how the yield curve evolves, right? Back in, say, 2024, we actually saw financials actually outperform even as the RBA started hiking rates back in 2024. But that's because, interest rates stayed high, but they were also quite stable. But say if this time round, if, depending on how fast, how much the RBA goes up, if they go up really aggressively, that could lead to more of an inverted yield curve, which would be a headwind for some of, the financial sector. So I think, very much case-by-case basis, and it's something that we're watching for. On materials, again, it was quite interesting that, we found, and our research actually found that it's not so much the local monetary policy dynamics that matters as much as the global commodity outlook for materials. And so, again, we went back, over 2 decades, so a bit longer. And we found that, materials, whenever they outperform the broader market, that actually coincided with different monetary policy cycles. It could be when, the RBA was actually hiking rates back in 2003. It could be when, the RBA started cutting rates back in 2020. And so there's not really a consistent pattern, relating, I guess, materials outperformance to that of the RBA cycle. I think really more so what matters is the outlook for commodities. And in particular, I think the gold piece is also quite interesting. So last year, we actually put on a tilt towards small cap, Aussie small caps, just given that they do have quite a bit of exposure to gold miners. So close to 20% of the, small odds index is actually, in that gold miner sector, which we think, could potentially benefit from some of the rallies that we're seeing in gold. So again, quite nuanced in terms of the picture. To your second part of your question in terms of the AUD, our view is that probably the risks are skewed more towards the upside at the moment, especially, if, to Navin's point, if we get that divergences in interest rate policies where, the RBA is going up, whereas, the Fed and a lot of the other developed markets are actually going down, then, that narrower interest rate differential could potentially, put more upward pressure on the AUD.
Terrific. Thanks, Beatrice and Ritesh. Lots of questions coming through on inflation and the RBA. So hopefully we've covered most of those questions through that update. So we might shift offshore, and Beatrice, if we can stay with you, if that's okay, across to the Middle East, and obviously a lot of news over the weekend and ongoing tension and conflict in the Middle East. But Beatrice, with that recent escalation, including sort of Iran-related risks, what's your base case or BlackRock's base case for how that conflict evolves and hopefully resolves?
Yeah, first, our hearts definitely go out to those that have been affected or are currently being affected in the Middle East. But in terms of the outlook, per se, our base case at this stage is, we see this more as a temporary shock rather than, a sustained, supply shock to the, system as a whole. But obviously, there are tail risks, and I think this is something that we're actively watching as a firm, as an investment team. In particular, two transmission channels that we're watching very closely. The first is through the transit channel, so the Straits of Hormuz, which, I think many of you would have also read in the news. That's a key, transmission channel for, energy supply across the world. So, that strait actually accounts for about 20% of global oil supply and over 25% of LNG and natural gas supply. So, to the extent that straits, gets closed or, that energy infrastructure gets targeted, then I think that, potentially would, increase that tail risk a lot more. The other aspect besides, this channel is production. So, just overnight we saw that Qatar actually halted its, LNG production, just given that some of the drone strikes actually hit their facilities. So again, if that's, more of a sustained, a permanent shock to the system, that could also, be something that, could have more of a stagflationary impact on markets. But at this stage, our base case is that, probably it's more of a temporary shock rather than, having a sustained impact. I think the key to watch is the severity as well as the duration of how long this persists. Our estimates suggest that if this lasts for, globally, I would say there is enough energy supply for, potentially 10 to 15 days. If the Straits gets closed, there's still a bit of buffer in terms of 1 or 2 weeks buffer. But if it lasts longer than that, say if it lasts for, months, 3-6 months, then that could have more of a detrimental impact and could potentially push oil prices, to even $90 or $100 per barrel, and obviously have detrimental impacts on growth and more of an inflationary uptick. So that's kind of how we're seeing markets in terms of bringing this back to the portfolios, in terms of how we're positioning in our portfolios. At this moment, we are not de-risking our portfolios because history has shown that just doing a blunt de-risking, following geopolitical events usually isn't rewarded, as is often a temporary shock. But rather than having a blunt instrument of reducing, equities or growth assets, what we prefer to do is to add diversifiers in the portfolio, just to make sure that it's resilient. And we can touch on some of the diversifiers later as well.
Terrific. Thanks, Beatrice. And Ritesh, if we can just stay on that theme for a little while. Given Beatrice's update, what sort of does that scenario imply for global growth, oil prices, and sort of typical sort of safe haven assets like gold, US dollar, treasuries, etc.?
Yeah, absolutely. So obviously there are short-term impacts and there are long-term impacts. So as Beatrice shared, essentially, we see this as a shock, but not a catastrophe. And what that means is currently the market is reacting to the news. And what is happening is you're seeing a lot of volatility in the equity markets across other asset classes as well. Particularly today in the Asian market segment, you saw a big amount of sell-off. And initially the reaction on the equity market was a little bit more benign, but you're seeing now as the war kind of keeps persisting and there is more retaliatory attacks, etc., the equity markets are getting a little bit more jittery. At the same time, if you look at other asset classes, obviously there is a flight to safety during these periods. So what you're seeing is US Treasuries rallying, US dollar strengthening as well, and asset classes such as gold rallying on these news bites as well. So overall, as Beatrice suggested as well, it is time to make sure that you're diversified and not having these concentrated exposure. On a more longer term basis, we've also mapped out how different crisis situations actually lead to market impacts on the long-term side as well. And the reality is, actually on the long term, most of these market events, the actual impact of it are very, very short-lived. So I think what will determine whether there is long-term impact is how long this crisis continues. So if it does continue for a few months, that's when we start to get a little bit more worried, because if that means that the oil prices stay higher, more than 10-20% from the current levels, then that can shave off a significant portion of the GDPs of some of the nations which are particularly vulnerable and are importing oil. So for example, China, India, and the likes. So these are aspects that you need to then consider in terms of how you're constructing your portfolio and how you're having exposures across the market as well. But overall, our base case view is that we don't advise clients to react to these situations by de-risking their portfolio, but make sure that you're diversified. These tend to be short-lived. Usually, you will see the bottom coming in within 20 days or so of such market events, and then the recovery takes another maybe 2 months. But over the longer period, once the correction has happened, if you look out 1 year down the line, 2 year down the line, 5 year down the line, the market's much, much higher.
Thanks, Ritesh. Also getting lots of questions coming through, not surprising, on AI. So we'll try and group some of those questions into a theme under AI, a structural shift or a bubble. But Ritesh, maybe if we just stay with you for the next question, if that's okay. Questions around an AI bubble. Is it durable, sustainable? Is it a growth story? And also, how do you interpret some of the recent tech sell-off on the market?
Absolutely, and I think Navin already covered a lot of ground on this, and even Beatrice. The reality is we are in the full-fledged rollout of AI, and it is not just a short-term phenomena. It is something that is fundamentally going to change our lives. So it is the next general-purpose technology, similar to the steam engines, similar to advent of electricity, etc., and all. And the kind of productivity boost that it can result in is the reason why we are all very excited about it. Now, obviously, during phases of this AI deployment, you are seeing some froth in the market, but I don't think we are still at a phase where we can call it a bubble. And right now, what is happening is the market is moving from a more capital intensity standpoint to a more kind of return discipline area as well. And what that means is the bulk of the focus was on the hyperscalers, and the amount of capex that is coming in is pretty phenomenal. We are looking at upwards of $600 billion being deployed in this year alone, and then continuing in the years ahead. But what that is also leading to is supply kind of choke points. And when you look at the overall value chain of AI, that's where you're seeing that on the semiconductor side, on the chip side, that's where a lot of action is happening. So it's still the picks and shovels, and this part of the segment is actually dominated by emerging markets, by Asia. So your Taiwan, your South Korea, and these markets, the returns have been phenomenal over the last couple of years as well. So if you're looking to invest into AI, again, as part of this theme around dispersion, the dispersion is in AI as well. So you need to be very measured and meticulous in terms of how you're deploying to participate in the continued growth story of AI, and make sure that you're able to capture some of these trends as they are unfolding as well.
Thanks, Ritesh. And Beatrice, again, sticking with AI, beyond markets per se, do you think AI will have a meaningful disruption to labour markets, like we've seen news over the last week or two around redundancies and staff cuts and whatnot? But are fears around that overblown, out of proportion?
Yeah, I mean, that's certainly a very topical and also a very polarizing topic, I would say. But, I think at this stage, what we are seeing right now in the jobs market is kind of that status quo where, I'm not sure if you guys have heard it, but, that no hire, no fire status where, yes, job growth across the board is slowing down, but at the same time, we are seeing some layoffs, but not, massive layoffs across the economy. And we think that, that's, potentially, going to be the case as well going forward. Sure enough, I think AI would potentially displace some jobs. But our base case is that AI would, importantly, be more self-effective, reshaping jobs rather than completely replacing them. And that's because, if we look at a job, and this is actually backed by our research as well, where we actually looked at over 800 different jobs in the U.S. using what we call the ONET database, which is a big jobs database in the U.S. And what we found was that a job is not just made up of one task, right? I'm sure, many of you here will be working, but obviously you don't do just one task in your job. In fact, a job is made up of multiple tasks. And we actually were able to group each task within a job across the 800 jobs into 3 key categories. And that is basic task, which can include things like, gathering information. Repetitive tasks, which is that of, processing information, for instance. But then there's also that, what we call uniquely human aspect of a job where, AI won't be able to displace. If anything, it will actually help augment, that aspect of the job. So, our view is that, with AI, we view it more as a co-pilot, right, in terms of helping to augment some of the basic and repetitive tasks and allowing us to focus more so on what we call the uniquely human task. And I think in this room as well, if you reflect on your jobs, whether you're a teacher, whether you're a nurse, whether you're a doctor, many of my friends have said that, a lot of people, even in those industries, have started to incorporate AI and, effectively makes them much more productive, right? Where, a nurse can essentially use AI to automate a lot of the electronic, patient records and spend more time on what she's best at, right? And showing empathy and patient care. And so I think that is something that, I think we will continue to see in terms of disruption, but for the better, not just in the manufacturing sector as, the Industrial Revolution, but more so I think this AI piece will be transformative, right? Even in services like healthcare, like education, like finance. And people are saying, they're worried that there will be too few jobs and too many people and too many workers. But actually, I'm actually worried the opposite, right? I'm actually worried that there will be too many jobs and too few workers. Because as we saw in my megaforce slide, that it's not just about AI disruption, right? We also have other mega forces like demographic aging, demographic divergences. And here in Australia, here in the US, Europe, China, we're all experiencing an aging population. And I think there will come a time where, we'll actually be having too few workers for, the newly created jobs in industries that, we see with AI. So more of an optimistic view on that topic, yeah.
Glass half full, definitely. If we just have a bit of a focus on the US, US markets, US exceptionalism and market leadership, Beatrice, both you and Navin sort of covered in your presentations the fact that US markets have flattened somewhat over the past 12 months or so compared to major peers. Is the US running out of steam? Is it a cause for concern, or is it just a temporary pause or lag?
Yeah, I think that's certainly very interesting to watch that country rotation dynamics that we're seeing at the moment, where we're moving from U.S. exceptionalism over the last couple of years to now, ex-U.S. exceptionalism, if you like. And even in our portfolios, we run model portfolios in the multi-asset team. In our own positioning, we've actually also started to trim back our overweight to U.S. equities. But more importantly, I think what we've done, besides, going from U.S. into other regions like Japan, like emerging markets, being also a lot more specific in terms of where we take risk within U.S. equities. So for instance, I mentioned we have added a small cap tilt within U.S. and also more of a value tilt after, having that large cap growth bias for the most part of 2024 and 2025. So selectivity, I think, is going to be important going forward. But in terms of, just from a cross-country perspective, I think it really comes down to a couple of things, right? One is that of earnings growth potential. So if we really think about, why has the U.S. significantly outperformed the rest of the world over the last couple of years, a key and the big reason is that of, the earnings growth differential, right? With earnings growth in the US, both on the realized and the forward-looking basis, being in the double-digit range, looking at 14, 15%, as compared to the rest of the world where, we're pretty much single digits, pretty much flat like a pancake. And so, from that perspective, I think that was very much why, the US has actually outperformed significantly. Now, going forward, if we were to see a material deterioration or even a moderation in the earnings picture for the U.S., then that could potentially be more of a signal that we will see a sustained underperformance in the U.S. rather than it being a temporary blip. At this stage, I would say we're not really seeing that yet at the moment. A lot of the correction has been more so on the valuation side, rather than actually reflecting, a fundamental shift in the earnings picture. But bears watching, I think. And then the other aspect would be the macro picture, right? Heading into this year, a lot of investors were really optimistic about the U.S. because of the macro backdrop where, anyone heard of the One Big Beautiful Bill? That made a lot of noise back in July, but it's somewhat petered out. But I think heading into this year, everyone was expecting that, the tax cuts and the effects of the tax cuts would come into play and support the U.S. economy. But I think now the level feels a bit more balanced as other countries like Japan, for instance, after that landslide election with Takashi-san, we did see that, they're also likely to inject more fiscal stimulus. So I think overall, things are becoming a bit more balanced today as compared to a couple years ago. We see a strategic case for investing in U.S. equities, but, I think even in our portfolios, we're starting to manage that balance of risk a bit more prudently.
Terrific, thanks Beatrice. And just by extension, Ritesh, so in the event that leadership does fade, like where to next? We're getting some questions around asset allocation, both geographically and sector-based. So do you have any thoughts on that?
Yeah, absolutely. And if you look at, just building on top of what Beatrice already shared, if you look at returns over the last year, it's after almost a decade that US market was one of the weakest major markets in terms of returns. So compared to the US market, actually Asian markets and emerging markets did materially much better, and more than 30% returns coming in from these markets compared to close to 16% coming in from the US. Now there are other aspects to just take a step back and think through where we are in the cycle as well. As Navin was pointing out, long term, we are looking at a more disinflationary environment, and what that also means is perhaps, if you put aside this Iran conflict right now, we are looking at more rate cuts in the second half of the year. And what that would mean is, on the rate side, interest rates coming down overall from a currency standpoint, that also translates into the US dollar continuing its weakening cycle. And it's important to note for last year as well, this is where the difference was. You made 16% in US dollar, but you lost almost 10% of it because the US dollar depreciated. So as an Aussie investor, if you only have concentrated exposure to the US market, then you're only making that 6-7% return. You could have probably made much better just in the domestic market, with the dividends, etc. You're looking at 10-11% in Aussie dollar. So when it comes to how you are allocating your investments, this is where the broader market or the market leadership is definitely broadening. And as earnings growth kind of picks up across the world as well, and with this US dollar weakening cycle, typically emerging markets do very well when US dollar is depreciating. So when it comes to, again, asset allocation, similar to what Beatrice was sharing, in our own model portfolios as well, we have trimmed down some of our extra US exposures. Within US, the concentration risks that are inherent in index strategies where 40+% of your exposure can be into the mega cap stocks. So it is important to go beyond just the index part of the US and take exposure to some of these value segments and small cap segments as well. So when it comes to US, I would look at those opportunities and then also trim down a little bit of the US exposure to look at investments ex-US, developed ex-US, as well as emerging markets in particular. And these are places where, again, selectively, if you allocate well, you can capture a lot of opportunities and still drive a lot of returns.
Terrific. We're getting some questions around, for a bit of a description, like investing in an uncertain world. I think given all that's happening, as I said at the start, both domestically and globally. So Ritesh, maybe staying with you if we can. How are you, or how's Syfe thinking about portfolio construction, asset allocation now, just given the higher levels of geopolitical and sort of macro risks.
Absolutely. So as I shared earlier, in this kind of an environment, clearly the thing is that there is dispersion in returns and there is dispersion in asset classes, geographies, etc. So we are calling it the year of selectivity. And what that means is you have to be very nimble in terms of how you asset allocate. On the equity side, as I shared earlier, you have to manage the concentration risks that are inherent within the US market and then pair it with diversification in the emerging markets in the developed ex-US markets, and there also be selective in terms of whether it is country or sectors as well. Now, if you go beyond asset classes, we are actually hugely positive about fixed income as well, because fixed income is now acting not just as a risk management tool, is actually contributing as a core return driver. And this was not true if you went back a couple of years, 2020, 2021 odd, when interest rates were close to zero. Now, actually, there is a lot of yield just baked in, or interest rate returns that are just baked into the base returns that you generate from fixed income. And potentially, again, barring the Iran conflict dragging on, if we are thinking of a more disinflationary environment in general across the board, again, Australia is slightly different, but you have a much higher kind of like starting yield to play with, and that gives you enough buffer to generate a lot of returns, both through interest rates, but also through capital gains on the fixed income side. And then on top of that, you have to think about, uncorrelated returns, and that's where alternative asset classes could be very beneficial. We have talked about hedging, so that's where gold and precious metals do have a place in the portfolio, again, to make sure that through these uncertain times, you have these components that can give you those uncorrelated returns and are not severely impacted by these downturns, etc. as well. And then on the alternative side, you have these, liquidity. They're less liquid in nature, but again, very uncorrelated to the public markets. So whether it is private credit, we again know that there are, some aspects that are being called into question within private credit, but private credit itself is a pretty big market, and there are subsegments within private credit that can be looked into, and similarly private equity and other asset classes as well.
Terrific. And just to wrap that piece up, Beatrice, you talked around whole of portfolio theory and diversification. Which ones do you actually see, like diversifiers, which ones are actually working when equities and or bonds kind of don't behave as expected? Navin touched on this in his presentation as well, but from a diversification perspective, which ones do you see as...
Yeah, we often like to talk about the principles about diversifying your diversifiers. And so, in our, speaking from a multi-asset perspective, like we look at not just one diversifiers, but multiple diversifiers within our portfolios. And, Ritesh, touched on some of them. So like gold is, an asset class that we actually really like. So we added in about 3 years ago. And I think, in hindsight, gold has rallied, over 80% over the last, 2 years or so, and it's up over, close to 20%, even on a year-to-date basis. So clearly, that is not just acting as a downside protector in terms of cushioning some of the equity sell-off, but also very much a return enhancer. So besides gold, income is also something that we like. So, I think it's striking to see, compared to, say, 5-10 years ago, where pretty much, your yield was, fixed income was yielding less than 1% of returns. But today, I think over 2/3, of the global fixed income market is actually yielding over 4%. And the interesting part is actually you don't have to go down the risk curve to actually get that amount of yield. Back in the days, you have to go, really down the credit quality spectrum to actually get, a decent yield. But today, even investing in, say, govie bonds, you could easily get, a pretty decent yield on that front. So besides asset classes like gold, income, we also like liquid alternatives like hedge funds. So, we actually do have an uncorrelated fund of hedge fund strategy that is uncorrelated to the rest of the market. It pretty much has a beta of, or, a correlation to the market of pretty much zero, across both equities and fixed income. So it provides us comfort that, regardless of what happens in markets, whether it's stocks up, stocks down, bonds up, bonds down, there's a component in your portfolio that's able to generate the consistent stream of returns across time. So that's on the asset class level, but looking beyond the asset class level, we also do look at things like currencies, for instance. Currencies can also be an effective diversifier in portfolios. So one way to do so is, say, the Japanese yen, right? So we have some exposure in Japanese equities, and the yen tends to be a safe haven currency that we like having in the portfolio. So that's also one way to express that diversification benefits. The others are through what we call factors. So factors are things like value growth, but there's also something called low volatility or minimum volatility. So that effectively allows you to stay invested in equity markets, but invest in, I guess, lower risk stocks like your Johnson & Johnson companies that are potentially a bit more resilient to business cycles. So different ways that you can slice and dice it, but in our portfolios we seek to as much as possible diversify across asset classes, across sectors, factors, and individual securities.
Terrific, thank you. Just conscious of time, we've got a number of questions also coming through that relate specifically to self-wealth by Syfe, which is great. Our platform, and Sam touched on the new mobile that was released a few weeks ago. Quite a few questions coming through on the mobile app. As I said at the start, we've got a number of staff here this evening who'll be in the foyer area after the presentation. We'd love to talk, have some one-on-one conversations, answer some questions. I will say on the mobile release, that's our first release. It's iterative. We're getting lots of feedback. We love feedback. Good, bad, and ugly. It helps us improve and shape things going forward. So please keep the feedback coming. What I will say is we are listening to your feedback. We hear the feedback, and we're moving faster than ever. I've been at Selfwealth for 8 years, so I can talk to that. But we're moving faster than ever in terms of taking on board that feedback and putting in place some updates and enhancements. So, but as I said, we'll be outside in the foyer after. Any questions specific to Selfwealth, the platform, the mobile, we'd love to have a conversation with you about that. I think that sort of wraps up the Q&A for now. So please join me in thanking both Ritesh and Beatrice. And I'm also really conscious that I'm one person standing between you and the foyer where there are cold drinks and hopefully hot food. So I won't spend too long on this, but I just wanted to reiterate the messages at the start, which Sam also touched on, to say thank you so much. It's great to stand up in front of so many of our wonderful customers. We appreciate your support, your trust. It means a lot to us. We are working really hard behind the scenes, whether that be updates, enhancements, new mobile, new investment opportunities. There's a lot more coming through over the next few months. So stick with us. As I said, we value the support and the relationship, and we're looking forward to those relationships continuing for many, many years to come. So on that note, I might close tonight's formalities. We'd love to stay for a chat in the foyer area. Thanks again to Navin, thanks to Beatrice, thanks to Ritesh for your presentations, and have a wonderful night. So thank you very much for coming.